Hey, everybody. Well, I am really excited for our session today. And I'm going to let Jamie lead today, but please go ahead and keep putting in where you're from and what the weather is, where you're calling in from. And just giving you a heads up, I love audience participation, so be ready. I will probably throw all sorts of questions at you today. And I just want you to be as fully here as you can be. And remember that today come with a beginner's mind. You may have heard some of these things, which is okay, but just make sure that you're actually applying these to your business. So Jamie, I'm going to turn it back to you to go ahead and kick off the call.
Thank you, Gail. Welcome to the Work of Design Live from Studio Designer, the industry's leading project management, time billing, and accounting platform for the interior design industry. I'm Jamie Brown, and thank you guys so much for joining in and tuning in with us this afternoon. At Studio Designer, our mission is to empower creativity by creating innovative business management solutions to help designers see their full potential. We actually launched this webinar series to share design business advice, best practices, and encourage knowledge sharing in our community. To deliver the very best content, we'll be partnering with thought leaders and industry experts like Gail in the industry to share their expertise on running a design firm and to grow our collective knowledge. Today, I am so thrilled to introduce one of the best business coaches in the industry, Gail Doby, co-founder of the Pearl Collective. I'll pass it back over to you, Gail, to be able to introduce yourself and to start the presentation, but we're really super excited to have you with us today.
Oh, thank you so much, Jamie. And thank you everybody for being here today. I am delighted to be here. I've been doing coaching now for over 15 years. And Erin Weir, who is not currently on camera, but she's my co-founder, and she and I worked together for 18 years. She started with me in my design business. So I have been around this industry for more years than I want to admit. And so therefore, I will just skip over that detail. Our firm has been helping emerging and also well-established design firms who are interested in shortcuts and making more money in this business, and also working with a lot more sanity and control. So anybody want a little bit more of that, just go ahead and chat in the screen for me. And I would love to, again, encourage you to participate throughout. And what we have found out is that a lot of designers want to be what we call a recognized design leader. And here are three things that we have found that you need to have in place so that you're going to be successful. The first thing is a powerful mindset. The second thing is a strong business and financial foundation. And then also a community that supports you. And when I was running my own interior design business, we used Studio IT, which was the desktop version of what is now Studio Designer. And that was actually a choice we moved off of, oh my gosh, 3 different softwares before we ended up on Studio IT. We did not have Studio Webware at the time because this has been a few decades ago. And it was really the thing that was a big switch for me, because my designers on my team had rebelled against all the other softwares and said, no, this is not for us. It's way too complicated. And so that's why we made the move. So that we have been around working with Studio Designer for years. We've had a long-term relationship with them, and it's what we recommend to our clients because we found it's one of the most robust platforms, and it fits the way that you do your business. So I welcome you all to the call today. And again, reminding you all throughout, just be sure and chat in if you have a question, if you have a comment. I will ask you for some feedback on some different things throughout, just to keep you engaged throughout this. And I encourage you to ask any question that you can think of as we go through the presentation today. So first of all, I would tell you that since I've been coaching now for 15 years, I've seen designers make a lot of disastrous financial decisions. And here are a couple that are very, very true, and probably more true than I'd like to say. The first one is that designers are passionate about design, and you'd work for free if you could. Tell me if that's true or not true. Go ahead and post that in chat. Not true for you. Okay, good. No way, not true. Very true. Okay. True. Okay. So we have some on both sides of the coin here. And I would tell you, and this, I'm going to say this because it's studio designer, the people that use studio are probably more serious about business than most designers out in the industry. And I love this one, not anymore. And somebody else says truth. I could be better at billing. Okay. I remember getting my first check and thinking, I can't believe somebody paid for this. I love that. Well, thank you for sharing. Honestly, I think it's kind of funny when I hear some of the stories, and don't feel bad, no matter which side of the fence you're on, but you should be passionate about your design. Of course, that's the reason you got into it. But the other part is, I hope you get to the point where you're passionate about business. And here's one of the things that I have found through some of my clients. They often start with us and they say, yeah, I got into the business because I love design, but I really don't like the business part. I want to always do design. And about 3 years into the program of working with us, it switches and they finally realize that they love business and they love making money at business. And we love for them to make money at business. So it's really a lot of fun to see that shift happen. I also find that designers hate talking about money, collecting money, and dealing with the unhappy clients that complain about their bills. Anybody there? They'd rather get a fork in the eye. And that's the way I put it. And a lot of people really, really, really don't like to talk about money. How many of you feel that way? Agree. Okay. So that's pretty common. And I would also say that a lot of designers could be said to have dysfunctional relationships with money and maybe a mindset that is not necessarily as healthy as it needs to be around money. And this could come from a number of different places. They could have had parents that struggled with their own business. They could have had lean times with their spouse. They could have grown up in an environment where every dollar was something that you had to fight over. And maybe you've had fights with your spouse over money. And some of those things can really relate to what you feel in your business as well. I also have a lot of designers that I've worked with that have this hate relationship with the numbers of their business, and they do this swipe over their head. They say that the numbers literally go over their head. And I have seen this many, many times. And one of my favorite stories is actually an architect client of mine. And she told me one time we were sitting down to have an all-day session. And she said, she did the little swipe routine. And she said, I just don't get these numbers. And I'm sorry, you can probably talk to me as much as you want. I'm not going to understand them. And after about an hour, all of a sudden she started crying. And I said, why are you crying? And she said, I finally get them. I finally understand the numbers. And so for me, that was just one of those things that really drove me to believe that if I can teach you all how to love your business and love the numbers side of it, you're going to make more money. You're going to be able to pay your team well. You'll be able to pay for your family expenses, trips, college, retirement, all those luxuries, sometimes big luxuries. And otherwise, if you don't have this love for making money and enjoying the business of design, there may be a point where you face going out of business because you aren't keeping track of what really matters. And that is cash flow and profitability. A lot of people get into this business because they love what they do, but they don't necessarily understand the numbers part of the business. So how many of you have a business degree? And how many of you can also relate to the fact that the numbers aren't your favorite part of the business? If you would just share that in chat, please. Agree. Least favorite. Absolutely not my favorite. Not my fave part. Hate those numbers. No business degree. Okay. Completely agree. Okay. Awesome. I love this because this tells me that you're in the right place today. Oh, here's one that loves numbers. Love that. Have a business degree. Um, they don't tell you how to run a business in school. That's very true. Okay. So this is pretty common. And some people have a business degree, but it's not your favorite part. I have a finance degree, and I remember that I really didn't feel like I learned finance and numbers until I actually started my first business, which was a design business. So I love them now, and I love teaching them. So here's the other real fact of this, because you can shift from being somebody who loves design into somebody who loves running a business that happens to do design. And that is the shift I would love for you to make at some point in your career. So here are a couple of statements, and we're going to talk through some of the statements today that you should be reading on a regular basis. And the first one is a profit and loss statement, also known as an income statement. And a lot of these make very little sense to designers. And balance sheets are almost a mystery. How many of you would agree with that? 100% agree, yes. Okay. So we have a lot of people that are on this. So here's the thing, that unfortunately, not understanding these two statements can lead to your business not being successful. And we don't want you to ever be in a situation that you are facing the business not working because you're not making enough money, because maybe you don't know where you stand exactly. And we're going to help you with some ideas today of things that you need to do, and also some of the statements you can pull up in studio to be able to make sure that you're on track. And here's something else that a lot of firms don't do. And I'd love to see if anybody does cash flow projections. Anybody in the audience do that? Okay, we have a handful of people that do and some people who do not. Okay, some do, for some try. Okay, not yet, but want to get there. Okay. All right. So cash flow to me is one of the most important statements that a lot of people do not do. And here's the thing, and I'm going to share this again. I will repeat this later because it bears repeating. But the balance sheet is everything that has happened in your business up to today. And it tells you the history of what's happened in your business. The P&L will tell you, or the profit and loss statement, also known as the income statement, will tell you where you are today as of this month or this day or this week or this year in your business. It's going to tell you how much you've sold, how much your cost of goods are, how much your overhead is, and what your net profit is. So that's really helpful. So that's the present. So we got the past, we have the present, and the cash flow is the future. And the future is what you need to predict, because that's telling you what your pipeline is. So having a cash flow projection is extremely important. And Erin, if you could just change that, I think we're almost there on slide 3. So the cash flow is going to tell you if you're on track for where you need to be in your business. So the first thing is, if you're not reviewing your income statement and balance sheets on a monthly basis with your bookkeeper, that is something that I would like for you to start doing now. And the reason you need to do that is so that you're starting to learn the language of money and the language of business. So it's almost like having to understand the words of design, like knowing what a CFA is. You need to understand what the income statement does and what the balance sheet does and the cash flow statement. So all of those things, if you would get in the habit of meeting with your bookkeeper on a monthly basis, at the very least, you will have a better sense of where you are within your business. And so also, not having your bookkeeper analyze your numbers on a daily, weekly, or monthly basis is another area where I see a lot of people making mistakes. Your bookkeeper can create a financial dashboard for you, and Studio has the ability to do that. And that's something you should be running on a regular basis, in addition to some of the other financial reports that we're going to talk to you about today in Studio. And then also another mistake that we see happen a lot is not updating your cash flow regularly and knowing how healthy your pipeline is. So right now, I think a lot of people are feeling that the pipeline is a little bit dry. This is kind of the summer season for a lot of people. Anybody experiencing that right now? Okay, so I'm seeing a lot of yeses here. This is pretty common. And we see in most businesses, especially if you are typically a residential designer, somewhere between March or April and into the end of July, it's a little bit quiet. So Jeff, where are you? You're saying it's your peak time. This is when we see often the phone calls are a little bit less because people are, their kids are getting out of school, they're going on vacation, they've just had tax season. All of these other things are very typical for the summertime. into the end of July. So there's good news ahead. I think we're going to see that things will pick up a little bit. And economically, a lot of things are very positive right now, and we're starting to see a turn of the corner. And also, for example, the stock market is getting strong right now. So there are a lot of really good signs that we're going to see a lot of activity in the fall. So definitely, we're seeing some shifts in terms of how much business is available right now. So I did mention, and of course you're here because you want to know how much of the cash in the bank is really yours. And we have had people spend more than is really theirs to spend. And here's why a lot of people get in trouble. They get to this comfortable level where they look at their bank account and that tells them that they can go spend money. Oh, I can go buy computers. I can hire another person. I'm ready to grow my business. And what happens is that they end up spending some of the cash that has been paid to them by their clients for the projects and for products. And they end up spending into more than they can really use. They should not be using that money that is their clients. So that's where I see people make a lot of mistakes. So we'll go on to that next slide. And the next piece is, and I'm just going through some of the reasons why people run into problems in their business. Just, you may not be doing these things, but I'm just telling you about them just in case so that you can avoid these issues. So for example, running your personal expenses through the business. And I understand that most everybody does that, but be very, very careful of that. And the best way, if you're going to do it, is to make sure that it's a draw and not an expense on your P&L. And so, for example, you could have a separate credit card that is personal that you could use for something that you want to be paid by the business, but your bookkeeper would know that that needs to be coded so that that is actually a draw for your business. Okay, so this is a great question. This is from Jennifer. She says, what is the difference between a draw and an expense? So this would require that I ask another question. And that is, how many of you are S Corps and how many of you are LLCs? If you would just type that into chat. While you're doing that, I'm going to really quickly turn on my fan. I'll be right back. Okay. So we have a mixture of LLCs and S Corps. Okay, so if you are an S Corp, the rule is that if you are an S Corp, you should be paying about half of your compensation through salary and half of your compensation through owner's draws. So what that means is that out of net profit, you're drawing money out of your cash account and it shows up as a draw on your balance sheet. So it's not something that shows up on your P&L as an expense because a salary is an expense before net profit. And I know that sounds a little bit confusing, but when we get to an income statement here in a minute, I'll show you what I mean with that. So it's really important for you to know. As far as which do you recommend between S Corp and an LLC, I would say that if you're starting to make at least 100,000 net profit, then you need to be probably an S Corp. And there are a lot of reasons for doing this, and I'll share that right now. If you are an LLC, anything that is net profit for you is considered your income, and you will pay Social Security on all of it, all of it. So the more money you make, the more likely it is that you should be an S Corp. So if you're over 100,000, you probably should be an S Corp. And that way you're only paying that the Social Security on your salary and not on your draws. So that's really important. That's a really nice benefit because that's about 6.8%. And so that's a big savings on taxes if you do convert to an S Corp. But always talk to your CPA. Yes, 100%, 100,000 of profitability. Yes, Jeff. So that just kind of tells you that that's one of the important things that you should know. And you should discuss this with your CPA and also with your attorney. And usually it's a pretty simple thing. You just changed how you report your taxes, and that's actually indicated on your income taxes. So your CPA can help you with that. Okay, so retirement compensation is a whole different thing. So Sabine, we won't be talking about that today, but unless we have some time at the end, because that's not necessarily part of what we're covering today, is if that's okay, Sabine. So bring it back up at the end if we have a few additional minutes. So again, going back to personal expenses through your business, the IRS frowns on this. So I know if you love to travel, you like expensive dinners and clothes, just make sure that you're really careful, because this is an area where you can trigger some sort of action by IRS, and you do not want to be audited. So be really careful about how you do your expenses through the business. Here's another error that I've seen a lot of people make, and this one could be very, very costly, and I've seen people go out of business as a result of this, and that's not having errors in omissions insurance. And I'll give you an example of this. I had a client that wrote down the wrong number on a roofing tile selection, and she was out of state. She was in New York, and her project was out by the shore, and it was a $50,000 mistake. And luckily, she had the insurance for this, and she was able to file against it. Otherwise, could you really afford to lose $50,000? And for a lot of firms, that means you'd have to make an additional $600,000 of revenue to make up for that mistake. So that is a huge mistake, and you want to make sure that you're protecting yourself. Here's another one that I'm seeing quite a bit of conversation these days. Some people are doing fixed fees, some people are doing hourly. And I would bet if I ask you this question, if you're really being honest with me, you struggle with doing time billing. Anybody agree with that? Correct. Yes, agree. Yes. Okay, so we have a lot of people that are struggling with tracking your hours. And if you're doing fixed fees, a lot of people do that because they don't want to track their time. But here's what happens if you don't do that. If you don't track your time, you don't really know how much time did you spend on that project. And if you were billing by the hour, would you make more? And I will tell you that I see designers typically undercharging by at least 50% if they are doing a fixed fee. 50%. So think about that. And that money goes straight to your bottom line. So if you're not tracking your hours when you do fixed fees or hourly, then it's really taking money out of your pocket. So if you love having a great lifestyle and being able to do everything you want to do, including paying your employees well, then it's really important to have everybody do a great job of tracking their time. So just to repeat that, Kristen, people are typically, if they're doing fixed fees, I go and look at their P&Ls, and mostly they are losing about 50% on what they could be making if they were tracking all of their time and doing time billing. So I would just tell you, I'm not telling you not to do fixed fees, but I do tell you that you should track your time and then benchmark your time on projects. And what that means is that you're actually figuring out how much time are you spending on these projects, and is that what you've allocated for that project? If you don't have benchmarks and if you don't track your time, then you probably should avoid fixed fees. So that's just me telling you from my experience, and I've been around this industry for decades, so I would just tell you what I see. Here's something else that I'm seeing quite a bit. It's another mistake, and that's letting wealthy and influential people bully you into low markups because they dangle the carrot of their friends that they're going to refer you to. And, or if you want to photograph a project, and I will tell you, it is not worth losing the money over it. I had a client in the last year that came to me and told me, oh, we're going to take this project and this is how we're going to charge this client. And I just about had heart failure. And I said, okay, if you sign this contract, you're going to lose $200,000. And they felt that they had to do it, and they lost about $200,000. And so I will tell you that it's really important not to fall into this belief that somebody is going to give you a referral to other projects. You just have to make the right decision on that project and that client to make sure they're the right people. The other thing is not marking up your products enough. And I see that a lot of people have low markups. And that's one of the things that is a common mistake that I see a lot of people going through. And especially lately, the economy has been a little bit weird. And so in this period of time, people are negotiating hard. and they are wanting you to keep your markups down. So be careful of this because you really have to know what the cost of doing business is so that you make enough money. So the markups are all over the ballpark. I'm seeing people very typically 20 to 30% is very typical of what I'm seeing. And that's not necessarily enough today. So I will just tell you that right up front. Okay, so those are some of the mistakes. And then I'm going to give you a few other ones that I think are also important for you to think about. This one is not raising your rates every single year. And I find that a lot of people don't raise their rates every single year. How many of you do raise your rates every year? Go ahead and type that into chat. You know, sometimes you have to lose that client if you're not going to make enough money on it. Okay, so every few years. Yes, you need to raise your rates every year because do you want to raise for yourself? And do your employees want raises? And if they want raises, then you need to charge more. And last year, our cost of living went up 8%. And this year it is going to be 4%. So if you haven't raised them in a couple of years, that means you need to raise your rates at least 12% just to keep parity with where the economy is going. Does that make sense, everybody? Okay. So definitely think about that. And if you haven't done it, it's time to put together a letter. And you can tell people if they're currently clients of yours, you can say, I'll keep you at this rate until say 90 days, and then we'll go to the new rate. So that's one way to do that. Here's another big mistake we're seeing, and that is drawing out more out of your net profit in any given year than 50%. And a lot of people think that just because they've made, say, $100,000 in net profit, that they have that is available cash to them. And that's not the same thing as cash. That is only telling you what the profit is. And the reason it could be different is you may not have collected that money. It could be an accounts receivable. So taking more than 50% out is not a good idea. So that's a rule of thumb that I would strongly recommend that you think about is if you look at your net profit, only draw out a maximum of 50%. The other part of that 50% needs to go into reserves for your business, and also it needs to cover your taxes. So those are the things that I would tell you to be prepared for, and only draw out a maximum of 50% of your net profit. So as you can tell, we have had some strange business cycles lately. We have had COVID, and then we got PPP money and ERC money, and a lot of people felt like they were doing really well. And people were starting to spend a lot of money on their homes. And then all of a sudden, it started slowing down around mid-year last year. And as we've come into this year, we have definitely seen a big shift. And it has been, again, a quiet cycle because we've had inflation and people feel less comfortable spending money. So what I would tell you is that you need to have money for these business cycles. And these cycles happen everywhere from 3 to 10 years. Here's another mistake that I see people make, and that is spending more than your owner's equity on your balance sheet. This is why you need to understand what the balance sheet is and what it is telling you. So if you look at your balance sheet and you see that your owner's equity is $200,000, then do not spend more than that because that is a problem. You need to make sure that you always have some cash available to cover the ups and downs and cycles of business. And I see this happen a lot. So if you have negative owner's equity, it means your company is insolvent. Okay, so I will go into what that means in just a minute when I'll go through the balance sheet for you. Now, this could be even worse if you're spending into the client deposits that should be earmarked for paying vendors. Again, I've seen this happen, and it's happened even this year. I've seen a few people talk to me about this, and it's just, I have heart failure when I see this. So I'm going to show you some of the reports in studio that you can run so that you can avoid doing that to yourself. So I could go on, but these are just a few of the things that I just want you to be aware of in terms of the mistakes, because it's your duty to yourself, your family, and also to your team to fully understand your numbers and make sure that you understand what is driving the success of your business. And the more that you understand it, the more confident you're going to be. And the bigger the impact it's going to make on your life and business. So how many of you would like to have a little bit more sanity and a little bit more money in your bank account? Okay. A lot of you agree. Okay, me. Yes, please. All right. This is pretty common. I see this a lot. Okay. So I just want you to know that learning financials can take you 1 to 3 years, and that's perfectly okay. If you We'll show you how to stay in touch with us, and I would strongly encourage you to take my financial session. I do a master class for about half a day, and I walk you through how to read these financial statements in detail. So when we get to the end, I'll share some information so that you can find out more about it. Okay, Katie took the class, said it was great. Okay, yeah, okay, love the financial master class. Yeah, it's really thorough. And if you don't know anything about financials, you will at the end of it. And we have people come back and take it over and over and over. So just know that that is the way it goes. And when you hit about 3 years in the business, you're going to know your financials and you are going to understand how to make more money in the business. Anybody want to make more money? Yeah, Susan says, great class, can take it more than once. 100%. Okay. Okay. Awesome. All right. So let's look really quickly at some of these statements that I've been talking about. And they don't make a whole lot of sense until you can actually see them. Yes, for once, I'd love to make money. I promise you, you can. I will tell you, I have one client. I've got so many client stories, but let me share a couple because they're always fun to hear. I have one client that came to me and she was working herself into the ground. She was doing about 300,000 a year in revenue. That means sales of product and time. And she was working about 60 to 70 hours a week. She was working from the third floor of her house, and she had little kids. And it's been about 7 years now, and she is 16 times her revenue. She is now in an office. She has 15 employees, and she has completely changed her whole life from this particular experience of having learned about financials. She is definitely a savvy business owner. So that's one of the ones I love to share. I have another client that came to me in 2018, and they were on the roller coaster of cash flow, and they were doing about 1.8 million, which was not bad, but their profit wasn't where it needed to be. So we worked on increasing that. And this year they'll do 8 million. So that's a pretty good turnaround for 2018 to 23. So that's not quite 5 years. Oh, that is 5 years now. Okay, so let's take a look at the P&L. That's the first statement that I mentioned to you. And the profit and loss statement is your current situation. That's what is currently happening in your business, either today, year to date, this month, whatever way that you want to run your income statement. That is what is the most common statement that business owners know. How many of you feel like you understand your P&L inside and out? You would give yourself a 10. You could explain it to your CPA or your business manager. Okay, so we've got a range, 6 out of 10, 4 out of 10, 8. No way. Okay, so let me just walk you through some of the basics here. And some of you are pretty confident at this. It's the balance sheet that throws you. So we'll talk about balance sheet next. But the P&L, we're going to look at this first. And okay, if your data isn't good, that's a problem. So you have to look at if garbage in, garbage out. So if it is a problem of somebody on your team entering incorrect information in, like your bookkeeper, that's a real problem. You need a different bookkeeper. If it is somebody on your team who's a designer, then you need to train them in how to enter information so everything is being registered correctly. So for example, one way that people can get off, and I've seen this happen too, is they will put a proposal together and their cost of goods is more than what they are billing the client. And that's a quick way to lose money and go out of business. So that is a common thing that I see too. So on the P&L, you'll see here that what we're showing right now is the part that is what I consider the asset. And so if you are showing sales, that means you are including anything that is a product sale and anything that's subcontractor revenue And also you are showing any time billing that you're doing. So you'll see that on the next slide, and that's showing your time billing. And the time billing along with your product and your subcontractor revenue is going to give you your total income. Okay. So if you hear the statement top line, the top line means your revenue for the business. And that would be this number that you're seeing at the bottom. It says total income. That is your total revenue. That is what is considered your top line. Okay. And the next statement that you're going to see is the next section of the P&L. If you'll just go to that slide, please. Oh, so we're just showing that top part. Interesting. Okay. Well, I'll just tell you then that on the next section, you're going to see the cost of goods sold, and that is how much you're paying for the products that you're reselling. So if you have a cost of goods sold, that means that anything that you're selling, cost of goods sold, that means anything that you're selling is going to have a cost. And when you deduct that from your revenue, that gives you something called gross profit. And that gross profit is still not accounting for all costs of operating your business. And so then you subtract out the overhead of the business. And the overhead is anything it costs you to operate your business, whether you sell $1 of revenue or not. So it's really important for you to understand those three sections. But the part that I think is the most important on the P&L is what is called the net profit. And the net profit is after you've paid all of your cost of goods sold, you've paid all your salaries, you've paid all of your overhead, which includes rent and insurance and anything else that costs you to operate your business. That is what's called your net profit. So again, like I said, net profit only means that's what you have billed out to your clients, less all of your costs equals your net profit. And that net profit is great, but you may not have gotten all the cash from your client. So if you're only billing out for 50% on your proposal, then you're waiting for that other 50% to get paid to have the cash in the bank. So what shows on your P&L as net profit may or may not be in the bank. And that's why, again, a lot of people make the mistake of thinking, I have 100,000 of net profit, and they might draw all that cash, but it's not in the bank. So they're actually spending into their client deposits. Okay, is design fee and time billing just hourly versus flat fee? It can include any of those. It just depends on how you have your bookkeeper indicate that on your P&L. Okay, so income freight means that that's the cash that you are getting paid by the client for the freight that it costs to get that product to their house. And the expense for freight is the actual cost that you're paying to the vendor or to the freight company for the freight. Does that make sense? Okay, how do you reverse the calculation to get to your percentage? Percentage of what? Okay, so what I said there made some sense. Okay, I'm just checking to see if I covered all the questions. Okay. That is the top section of the income statement. Yes, that is the correct slide. Yes, Megan is asking a great question. Do people typically mark up freight? And yes, you should. So if you have somebody that is billing your client and is paying bills to the vendors, that means you've got a cost of providing that product with the freight. So you should mark it up so that you have some margin in there to cover the cost of your employees. Otherwise, you're losing money. Yeah, you're seeing page 2 of the P&L. We're missing the last 2 sections. Yeah. Okay, so marking up your freight is a good idea. Katie said you started doing that last week. Again, if you want to see the full income statement and have that training, definitely come to my financial master class. Okay. So there is a preferred chart of accounts that is already in Studio Designer. They have that as a common setup, and I would use their setup. I think it's a really good chart of accounts. And so things like import duties or other expenses, those kinds of things could still be put under freight, but you can also add a new chart of accounts for things that are unusual like that if you want to track that. You know, as far as marking up freight, explaining that to your clients, you have a cost of doing administration. So having an accountant and a bookkeeper to pay the bills and also to bill them is a cost of your business, and therefore you need to have some sort of a margin in that to be able to cover your costs. Okay, I would definitely mark up your freight if you aren't doing it. Okay. All right. So let's look quickly at the balance sheet. We're just going to do that quickly. Again, I'm not going to go into just a ton of details here. I just want to talk about this. Okay, Megan's asking how much you mark up your freight. I've seen everywhere from 10% to 20%, usually is pretty typical. And it is not the same as products. Does Studio Designer sync to QuickBooks, and is it a place in place of QuickBooks? Yes, it's in place of QuickBooks. So hopefully that helps. Okay. So if marking up freight to cover administration, should you not be charging hourly for admin? Yes, I would still charge that too, because you have a cost of paying the employee, but you also have a cost of just doing that operation of that work. Do you bill bookkeeping hours to the clients? You can, but I think that's one of the harder things to get them to cover. So I would just consider that an overhead item for most of the people that are billing for that. I think typically that is not the case. But if they're doing something more project management oriented or expediting, then you can bill for those hours. So just keep in mind that there are two different things there. Okay. So let's look really quickly at the balance sheet. And I want to talk to you about this in terms that you can all understand. How many of you own a house? Yep. Okay. We've got a lot of people that owns houses. So you understand that if you were to look the value of your house up on Zillow, that you would see a price for your house, right? Give me a right on that if you agree. Okay, so that is the market value of your house. So the market value of your house is what is called an asset. That's something that you own. And then if you look at the next section, which is the next slide, please, which is your liabilities. Your liabilities, if you go to that next slide, if you're on that, I can't quite see it. The liabilities are like your mortgage. So if you have a mortgage, that's a liability. It's something that you owe to somebody else. You do not own that. So that helps you understand the balance sheet. And then the equity is what's left over. So the reason they call it a balance sheet is your assets have to equal your equity and your liabilities. So if you want to know your equity, you're going to take assets minus your liability to get to your equity. So that is a very simple way for you to understand what a balance sheet is. Does that make sense to everybody? Okay. So I have just simplified what what a balance sheet is for most people. And it's something that once I figured out how to tell people that, it really helped them to understand that this is not as complicated as you think it is. Do you think it's beneficial to have QuickBooks and Studio or just Studio? I would stick with just Studio. I think it's a lot of extra work to do double entry, and I think you're going to have lots more mistakes if you have both. Yeah, you should have somebody. It's really good to hire somebody who really understands Studio. And otherwise, you're going to have so much confusion over the two statements, and you're never going to have your financial statements ready on time. Jennifer says, yes, don't mix the two. We have to do this being in a different country. Sorry about that. That's unfortunate. Okay, so that last section of the balance sheet, go ahead and show that equity piece. That is what I was talking about. So we have the asset minus the liabilities equals the equity. And that tells you what you have left over. Do accountants understand Studio? No. That's why I would tell you that there are a lot of people who understand Studio. You have a lot of people on the website, don't you, Jamie, that are very, very, very proficient in Studio, and they are phenomenal. And there are many of them that are specialists in this, and that's all they do. So I would highly recommend that. Transitioning from Ivy to QuickBooks, how does that work? Well, again, hire somebody who's an expert to help you with this. Okay, Leslie says, seems we're missing some things in the asset area that should be there, like client deposits. Client deposits are actually a liability. I'm glad you brought that up because a lot of people think that it's an asset. It is not. You owe that product to the client. They have given you money. And until you deliver it, it is a liability for you. Okay. So hopefully that will help. Vendor deposits are an asset. That is correct, because you have paid for those and they're in process. And so therefore that is considered an asset. Okay. So client deposits are a liability. Vendor deposits are an asset. And again, if you can just keep those two things in mind and make some notes on this, this will be something great for you to be able to understand for later. Okay, owner's draw is a deduction from equity. So essentially, if you're taking a draw, you're taking a negative out of your equity. You're deducting from equity. So if you had equity of 200,000 and you took a draw of 50,000, then your equity would drop to 150. Okay, so a vendor deposit is, say you pay 50% to that vendor, and it is a work in process. It is something that you do not have yet. So therefore, it is a vendor deposit, but it is an asset because it's something that if you had to, you could take that product if it came out of production and you could sell it to somebody else. So it's an asset, but it's just not liquid. Okay, so retained earnings means that it is all the money that you have generated in profit in your business over the course of the years that you've been in business. Net profit is only for the current year. Okay, two different things. Retained earnings is all years up until today, and net profit is this year only. So you'll see your retained earnings up to January 1 of this year, and it won't change again until you close out your books at the end of the year. And that profit and loss will then go into retained earnings. Okay. So an owner's draw is something that you deduct from owner's equity. So you can take cash out of your business. So you have to also balance that transaction and subtract it from your equity because you're taking cash and equity out of your business to take that draw. Okay. Okay. Yes, COGS does not hit the income statement until you invoice it in studio. That is correct. When it's in proposal phase, then it is on the balance sheet as a vendor deposit, and it's also a client deposit. That's why you have to have the balance sheet. We don't have owner's draw in ours. Doesn't mean our bookkeeper should add. Yes, you should have a line item in your chart of accounts for owner's draw. Okay, so let's go back to the slides really quickly. And like I said, we can't go into a deep dive here. Sounds like you all need to come take our class. If you are asking these questions, I encourage you strongly, come take the class. You'll get a repeat of all this, and we'll give you worksheets and all sorts of fun things. Okay, so let's talk about financial sanity rules. And I would tell you that having a great bookkeeper that understands our industry is essential. And if you don't have a bookkeeper that understands our industry, you're going to have you're going to tear your hair out over time. I've been talking to clients this week in coaching calls that are having that same problem. So what I find is most bookkeepers do not understand the industry and the complexity of what we do. So you have to meet monthly with your bookkeeper and they have to understand our industry. You can do cash flow projections, and I'm not going to get into a lot of that today, but I will show you just a little bit today in just a minute. Okay, the cash flow report will give you anything that you have entered into Studio, but it won't give you things that you haven't actually proposed yet to your clients or things that you haven't billed out to clients. So cash flow will only take you through anything that was entered into Studio. So all the other things that are in your pipeline. So for example, you meet with a client and you're not going to, you might just bill them for retainer, but you're not going to actually bill them for product or send out a proposal to them until later. So that is revenue that you know is going to come in, but it is not currently in your cash flow projection. So that's why you need to have one. And Erin is showing you what a cash flow projection is. And this is something where you have to spend the time to enter in what you expect to earn from your clients in terms of fees and also in terms of product. Okay. So again, make sure you have a good bookkeeper. I think using something like Studio is really important because it gives you that project management, time billing, and accounting. And it gives you a lot of different reports to assess your profitability and your financial solvency. So there are a lot of reasons that Studio is so good for this. Just make sure that your team is trained to enter the information correctly and that someone checks the work. And if you don't understand it, then how do you know that your bookkeeper is doing a good job? So that's why you really need to understand your financials. No, this cash flow report is one of our proprietary tools. So this is one of our tools that we don't share. I'm sorry, but this is one we share in some of our programs. So make sure your company has a cash flow projection that's kept current. And it's pretty simple. You can do a simple spreadsheet on this, but you can predict what your revenue is going to be for time billing or fixed fees, and also for future sales to that client. So that's something that you can discuss with your bookkeeper, and that's just the high level version of that. So the cash flow statements and projections, you can do the things that are included in Studio, and you can print that off, and you can see that for anything that is entered into Studio, but things that aren't entered into Studio, you have to add in that information. Okay, so just make sure that you have a cash flow projection that's kept current when you have new projects coming in and you sign a new contract, or when your projects evolve and you know what your product sales and time billing are going to be. So let's go ahead and go down to slide 14, Erin, and that's the Studio Designer Work in Progress report. I want to make sure and show a couple of other reports that are very useful. You will get this, Maria, I promise. Okay. It is just, I know you feel that it's not easy to get, and we're going through this quickly, but you need to take the class a couple of times to understand it and to really let it sink into your head. Like I said, it takes 1 to 3 years. It definitely feels made up sometimes. I get it. And I feel for you. I know for all of you that are non-financial people, this is a little bit hard to get your head around it, but I trust me, you will learn it. Okay. So a work in progress report is one of the reports that will tell you how much you have paid to your vendors and how much you still owe. And this is one of the things I talked about, is you definitely need to make time to understand this work in progress and look at this every single month at least, and see what your work in progress is and what you owe to your vendors. Because that cash that's sitting in the bank accounts, you need to make sure that you have money set aside to pay the vendors for that. So work in progress is one of the reports you should be pulling. Let's go ahead and go to the orders by vendor, because that is going to be doing a similar thing. It's going to show you the orders by the vendor so that you can see that this is what you've paid and this is what you still owe. So that's another way of making sure that you have cash set aside to pay that. And then also you need to be aware of the next report, which is your accounts payable by vendor. And the reason you need to know this is you have bills that you pay for your operations, and you need to know what you have to pay. So that could be anything from sales tax to paying a credit card bill to paying for cravat fabric. It could be anything. And you are also, yes, sales tax should show up on this report too, I believe. And correct me if I'm wrong here, Jamie or Rachel, but I believe that is correct. Okay. So let's go into a few more financial sanity rules, and then I'll open up for some questions. And I know I have some up here in chat, and I'll get to those in just a second. So here are a few more financial sanity rules. Get to know your banker and meet with your CPA quarterly to review your taxes so that you know what you owe for taxes. That's really important as well. Set up a line of credit when you don't need it, but don't use it just to operate your business. You need to understand what you really have available to spend in your business. That's why these reports that I just reviewed are so critically important. You should also shoot for 6 months of reserves in your bank. And that means that if you look at your P&L statement, you should look at your overhead expenses. And if it costs you $200,000 to operate for the year, then you need to have at least $100,000 in reserves for your business. I would highly recommend that because it helps you get through the cash flow cycles. Like right now, when things are a little bit quiet and the pipeline is a little bit dry, It will help you get through those cash flow periods. So the other part is know how much you owe and when it's due. And so those reports are absolutely gold. You must know that. So hopefully that will help. And I will tell you that just kind of to wrap up, I've had a lot of tearful conversations after reviewing financials with our clients. One of the first people that I met with, this is years ago, probably 12 years ago, I did my first VIP day and I looked at her P&L and I said, oh my God, I looked at her P&L and her balance sheet. She had 6 weeks of cash left. And we had to do some serious work to turn her business around. But she is now running a multi-million-dollar business. So for those of you who feel like this is hard to learn, you will learn this and you can avoid going through what she did. So I really believe that one of the things that I think is so wonderful about our industry, you can make a lot of money in this industry. You can make hundreds of thousands of dollars a year. I have a handful of clients that are making over $1 million net profit after they pay themselves a salary. So it is possible to make a lot of money and achieve financial wealth. So I just wanted to share that with you. And we'll take a couple of questions and then I'm going to we both have a couple of announcements as well. So, okay. No, we don't get into how to run tax reports. Your bookkeeper should be able to do that, Carrie. But if your bookkeeper is not doing a good job of that, it sounds like you might need to look at a different one. What about sales tax collected that you owe the state at the end of the project? Is that shown on the work in process report? Can one of you answer that for me? Manually tracking it right now. Are you using, Leanne, are you using Studio? Okay. So Erin says we've added a column to work in process to show the future taxes due as well. So that's great. The Studio is accrual, and accrual is a better way of looking at your numbers because you're looking at things that you know that you need to pay in the future, and it's also looking at things that you're going to collect, such as accounts receivable. So it's really important for you to run an accrual, and your bookkeeper or your CPA will convert to cash basis when you do your taxes. If you know your cash flow is stable and you know you've got a left that you're not spending into your client reserves or your client deposits, then that's wonderful. But cash flow projection also tells you when you can afford to make investments in your business and when you can afford to bring on teams. So I think cash flow is really important for you to track. Megan says money is fake. Okay. All right. I'm just looking through this real quickly to see if I've missed anything. If I've missed anything, feel free to pop that back into chat. What report do you use for cash flow projections in Studio? If one of you would share with me which one that is, that would be great. And Jamie, would you like to go ahead and share your event?
Yes, absolutely. I can actually announce both of them because they're two exciting events coming up in August. The first one is on August the 16th. So that is going to be run by Studio Designer as part of the Work of Design Live. So similar format to how we've had today. The topic for that is going to be how to get paid for your value. So in this webinar, you're going to be learning about different pricing models and strategies to help monetize your value as an interior designer. You'll also learn how to accept client payments efficiently and securely with Studio Pay. And I can drop a link in the chat below as well, just so that you'll be able to register for that. And Gail, do you want to talk about Operation Thrive that's coming up in August as well?
Sure, my screen just went away. So let me just pull that back up. Sorry. Okay. So we have an event coming up. It's an all-day session called Operation Thrive, your interior design battle plan to winning the economy in 2023. And it's an all-day event with industry experts, some of our good clients and friends, and we'll help you get a plan together to win in this economy. So we want to help you survive and thrive in this. So we're going to talk about how to generate leads and sell in this economy, how to operate your staff while keeping your costs down, and how to make your interior design business thrive during any crisis, and a lot more. So we have the link up here to sign up for this. It's on July 20th. Um, I'm sorry, the registration opens on July 20th, and it is an all-day Zoom event, and we will look forward to seeing you there. And I wish I could answer more questions, but I must leave. And I thank you all for being here on the call today. And I hope you learned something today.